All right, let's jump right in. Think about how you instinctively define the word risk in your daily life. If you're like most people, your mind immediately jumps to something dangerous, right? Driving a car way too fast, walking a little too close to the edge of a cliff, or, dumping all your savings into some highly speculative crypto asset. In our everyday experience, risk is almost always tied to a negative outcome. We try to minimize it, avoid it altogether, or buy insurance against it. But what if I told you that in the world of finance, this one-sided view of risk is completely backward?
Take a look at these traditional Chinese characters for the word risk. The first character stands for danger, but the second character actually stands for opportunity. I absolutely love this because it perfectly blends the two forces at play. You see, this is exactly how financial professionals actually measure risk. It is an inseparable mix of the danger you face and the opportunity you stand to gain. You literally can't have one without the other, and to truly understand valuation, you've got to understand both.
So, welcome to this explainer. Today, our goal is quantifying the unknown. We're going to take this vague kind of emotional feeling of danger and shift it into a concrete, purely statistical metric. We'll explore how top analysts measure the true value of an asset, not by guessing, but by literally quantifying the unknown.
Here's a quick roadmap for today. 1. Danger and opportunity. 2. Actual versus expected returns. 3. The statistics of risk. 4. Diversifying the danger. And finally, 5. Standardizing risk with beta. Let's get into it.
Starting off with Section 1, Danger and Opportunity, Rethinking Our Assumptions. Look at the stark contrast between these two definitions. Over on the left, Webster's dictionary defines risk as exposing to danger or hazard. It's entirely focused on the downside. But look at the right side. The finance definition of risk is the difference between actual versus expected returns. It encompasses the downside, yes, for sure, but it also includes the upside. In finance, risk isn't just about the danger of getting a speeding ticket. It's equally about the opportunity of arriving at your destination way earlier than expected. Think about it. If an investment suddenly doubles in value when you only expected a 10% return, that investment is technically highly risky, even though you're obviously thrilled with the outcome. Moving along to Section 2, Actual versus expected returns, the foundation of financial risk. This quote from Aswath Damodaran really hits the nail on the head. He says, risk refers to the likelihood that we will receive a return on an investment that is different from the return we expected to make. I really want to emphasize this point. Risk isn't just about losing money. It is simply about uncertainty. It's the uncertainty of your actual outcome compared to the one you planned for. If you buy a default-free government bond and hold it to maturity, you know exactly what you're going to get. There's no divergence from your expectation, so technically it's riskless. But the very second there's a chance your return could be higher or lower, boom, you introduce risk.
All right, Section 3, the statistics of risk, measuring the spread.
So how on earth do we actually measure that uncertainty? Well, we have to pull this theoretical concept down into the rigorous world of mathematics. Let's translate these statistical terms into plain English. Variance and standard deviation are just mathematical tools that measure how widely the potential outcomes fan out around your expected average. Imagine you're throwing darts at a dartboard. If all your darts hit right around the bullseye in a tight little cluster, you have a very low variance. But if your darts are just scattered all over the board, some hitting the wall, some hitting the outer rings, a lucky few hitting the bullseye, you've got a high variance. The wider the spread, the higher the standard deviation. So, standard deviation effectively measures that spread of actual returns around the expected returns. And crucially, it captures both upside and downside divergence. Remember, we care about the opportunity just as much as the danger. The greater the deviation, the greater the variance, which ultimately means higher variance indicates a riskier investment. And here's the so what of all this. Rational investors absolutely despise uncertainty unless they're getting paid for it. To convince an investor to bear the burden of a high-variance investment, they will mathematically demand a higher expected return as reward.
Which brings us to Section 4, Diversifying the danger, because not all risk is created equal.
Okay, here is a major plot twist. Statistical models prove that the market doesn't actually reward you for taking on every single type of risk out there. Risk is actually split into two distinct categories. On the left, we have firm-specific risk. This is the danger that a CEO makes a completely terrible decision, or a factory catches fire, or a new product launch is just a total flop. It affects one or maybe a few specific investments. But here's the secret. You can diversify this away. If you own hundreds of different stocks, one factory fire isn't going to ruin your whole portfolio because another company in your basket might have just invented a cure for a major disease. The ups and downs literally cancel each other out. On the right, however, we have market risk. This involves massive, sweeping economic shifts, like interest rate hikes, inflation spikes, or global events. It affects all investments. You simply cannot diversify it away.
So the absolutely crucial point here is understanding who actually sets the prices in the market. It's the marginal investor. Now, the marginal investor isn't someone putting their entire life savings into one single meme stock. No, they are large, institutional, incredibly well-diversified participants. Because they are fully diversified, models like the capital asset pricing model assume they have completely eliminated firm-specific risk from their portfolios already. Therefore, they only care about and are only rewarded for market risk. The market simply will not pay you a premium for taking on silly firm-specific risks that you could have easily avoided just by diversifying.
Finally, Section 5, Standardizing Risk with Beta, the ultimate metric.
So the big question is, how do we take this non-diversifiable market risk and turn it into a single standardized number we can actually use? Well, it starts with covariance. Covariance is just a statistical measure of how much an individual asset's returns move together with the broader market. Think of it like a dance. If an asset tends to step forward when the market steps forward and back when the market steps back, it has a high positive covariance. It's adding risk to a diversified portfolio. But if it moves totally independently or even in the opposite direction, it might actually lower the portfolio's overall risk. Covariance is how we figure out the exact amount of risk a new asset adds to an already well-diversified portfolio.
But we run into a little problem here. Covariance is expressed as a really messy percentage. Saying a stock has a covariance of 55% with the market doesn't really tell you intuitively if it's safe or dangerous, right? So we standardize it. Step 1, we calculate the covariance of the asset with the market. Step 2, we calculate the variance of the market portfolio itself. And then step 3, this is where the magic happens, we divide the asset's covariance by the market's variance. This simple division creates a clean, perfectly standardized metric known as beta.
And that brilliant little calculation leaves us with this number right here, 1.0. The beta of the average market portfolio is exactly 1.0. This gives us the perfect anchor. If you calculate the beta of a stock and it comes out to 1.2, you instantly know it's 20% riskier than the market average. If it comes out to 0.8, you know for sure it's 20% safer than the market average. It completely demystifies the chaotic complexity of market risk into one single elegant number that tells you exactly how much extra return you should demand for holding that asset.
So we've successfully moved from a vague emotional feeling to a precise statistical measurement. But ultimately, investing remains a deeply personal journey. If higher variance mathematically means higher expected returns over the long run, well, that brings us right back to our original metaphor of those Chinese characters. How much danger are you truly willing to stomach to achieve your opportunity? The math can absolutely tell you the exact beta of an asset, but only you can decide what your personal portfolio's beta should be. So take a hard look at your own investments today and ask yourself, are you truly being rewarded for the risk you're taking? Thanks so much for joining me on this explainer, and keep questioning the unknown.